Hello, my name is Elizabeth Shortino. I am a non-resident fellow at the Atlantic Council and also a managing director at Alvarez & Marsal. And I am so pleased to be here today to speak with two debt experts, if you don't mind me calling you that, from the IMF and World Bank. So I'm here with Allison Holland, who's the Assistant Director of the Debt Policy Division at the IMF, and Eva Korczyc, who is the Practice Manager at the World Bank for the Global and Macroeconomic Debt Unit. And we are looking forward to a very good conversation about the outlook for sovereign debt in low-income countries, particularly when it comes to the changes we're seeing in official development assistance. So let's just kick it right off. A little bit of background for why I wanted to do this session with both of you is we're at a very interesting time, an inflection point, you might say, for these low-income countries. You saw coming out of COVID at very high debt levels, a lot of fiscal constraint, rising interest rates that caused liquidity challenges for some countries, and really a spike in some of the countries that had high risk of debt sustainability and countries that needed debt treatments. But we also saw the IMF and World Bank really step up and support the sovereign community in terms of, launching things like the Global Sovereign Debt Roundtable and coming up with a three-pillar approach to support countries facing liquidity. So I think the question now is, what next? Are we on a trend of countries kind of moving into a better place with fewer risks to debt sustainability? Or are we in a trend where risks to debt sustainability might rise because we are facing so much uncertainty and, in particular, declines in official development assistance? So that was what I wanted to chat with you both about. And maybe I'll kick it off by asking you both just for what is your outlook from 2025 onward for kind of the trends in this space? And maybe, Allison, let's start with you.
Thank you very much, Elizabeth, and it's great to be here with you this morning. So just in terms of the broad outlook for low-income countries and specifically the debt issues, so you may have already heard the headline message for our annual meetings is that things are better than expected. So we've just launched the World Economic Outlook this morning, and so if you look at that, you'll see that for the low-income countries, growth has generally held up relatively well for 2024 and 2025 and is set to sort of modestly improve over the next couple of years. In parallel, we see that debt levels have broadly stabilized and are potentially likely to come down marginally over the near term. And I think, as you said in your opening remarks, we have seen sort of the number of countries at high risk of debt distress begin to moderate. So, as I said, there are some things that look better than we feared. But I think we also see that things are still not good, right? So, growth has been very divergent across the population of low-income countries. Some countries are doing relatively well. Some countries are really still struggling. Even though the number of countries at a high risk of debt distress has come down, it's still really quite high. And we still see that even though there's been like a continued tightening of credit spreads, overall financing costs still remain high. And one thing that really strikes me when I think about the challenges facing low-income countries is that you see that debt levels have stabilized. Growth has been, relatively steady, but debt levels have only stabilized despite the fact that primary balances have really tightened. So countries have been doing a huge amount of fiscal adjustment, but we're not seeing the full benefit of that in terms of declining debt yet. And that's really at the heart, that really reflects the fact that interest costs are still very high, the debt servicing challenges you just mentioned.
Yeah, that makes a lot of sense. Over to you. What are your thoughts on that?
Thank you so much, Elizabeth. It's really a pleasure to be here with you and with Allison to share this panel. With Allison, we are a little bit like partners in crime because both the bank and the fund works very closely on the issues that are related to that, and we actually share the assessments, and we've been working together a lot to try to understand what the current actually situation is, how the landscape of debt vulnerabilities has been changing, what were the actions that countries took, and what was the reaction action or the support that they've received from international community over the past few years that kind of helped to stabilize this situation a little bit. Because as Allison said, we see this stability that is very welcome in the debt levels, at least, that are even, as we discussed here, going to slightly decline if all goes well next year. But what we also see is that the nature of risks is sort of shifting. What we saw a couple of years ago, and that's what you, Elizabeth, highlighted when you mentioned that the global community came together to create GSDR, the G20 Common Framework, we feared that there will be many countries facing solvency issues, countries with unsustainable debt. And this has materialized to some extent. There are still pockets of vulnerabilities, as we are discussing here, countries facing those challenges, but the nature is increasingly shifting toward liquidity pressures. Liquidity pressures meaning that there are increasingly large number of countries who are facing debt service payments that are very high. And that situation is not likely to change in the short term. So we will see this pressure coming on that repayment that's there. Allison mentioned, of course, governments have consolidated. That should have helped. That helped a bit with that debt stock, but it didn't really help with the financing needs and debt service pressures that we are saying. So I think the overall assessment is, yeah, there is some relief because no systemic debt crisis is on the horizon, but the changing nature of these shocks calls for vigilance and action as we go forward in assisting countries.
Yeah. So we have improvement, but it's more stability as opposed to, a decline in debt. I'm picking up kind of on these liquidity challenges. A year ago, the IMF and World Bank first announced this 3-pillar approach to help countries that really have more of the liquidity challenges versus the solvency issues. And I recall when I was at the IMF working, hearing all about this, the Treasury Department was a very big supporter of it. Where does that stand? Is it something that you are finding countries are really responding to and that you're able to achieve some concrete outcomes around this?
Well, yes, that's obviously the expectation. And indeed, we feel that it is extremely important to tackle the issue of liquidity because, as we all know, what is a liquidity problem today, if unaddressed, couple of months, years down the road may turn to be a solvency challenge. So indeed, we saw it coming, and jointly with the team at the IMF and the bank, with support also from bilateral creditors and stakeholders, we came up with what is called the 3-pillar approach. So the 3-pillar approach, as the name suggests, includes actions along three pillars. The first component of it is domestic reforms. So that's increased focus on what countries can do actually themselves with the support of international community, how they can mobilize domestic resources. When I say resources, I mean both revenues in the form of tax, but also how they can mobilize capital through development of their domestic debt and capital markets. So reforms that support growth and support a reliable financing so that the countries can continue servicing their obligations, but at the same time they have fiscal space to pursue what is good development, that is investment in infrastructure, education, health, and so on. So that's the first pillar of the approach. So the reforms that countries need to do with the help and assistance of institutions like ours. And then comes the second pillar. The second pillar is about increased external financing, and the financing coming from both the IFIs, but also from the bilateral creditors. And then once you have those elements, then for some countries what actually also is needed is to take specific action on their debt profiles and see how this debt profiles or the spikes in debt repayments can be smoothened. And that's where I think we emphasize the role of the private sector. But your question is, okay, that's the 3-pillar approach. What are you guys doing about it? So there is some good news there. We are, working hand in hand on 2 types of approaches. First is to actually refine the toolbox. The available approaches and options and solutions that countries have so that they can understand. And I will give you 2 examples. For the first pillar, what we are piloting jointly with our colleagues at the IMF is the so-called Joint Domestic Resource Mobilization Initiative, GDRMI. We love abbreviations in both of our institutions. So this Joint Domestic Resource Mobilization Initiative helps us coordinate with client countries that are interested, the reform agenda in those critical growth enhancing or revenue mobilization areas, and support them with the technical assistance that we can provide, or the fund can provide, or external partners can provide. So we have put those modalities of enhanced collaboration at countries' disposal. For the third pillar, that includes action on debt, we are thinking of, how to incentivize, or maybe better, provide options to countries on how they proactively can manage their portfolios. When they see debt spikes, how to, in a market-friendly way, come together and refinance it, reprofile it through buybacks, debt for development swaps. At the World Bank, we have a unified MIGA guarantee platform that offers some credit enhancements that can be sweeteners for this type of deals, that can allow countries to tap markets at better rates at the time when they might not be able to do it on their own. So this stream of work on refining the toolkit includes those elements, but there is a second one which actually has to do with enhanced collaboration, and with Allison and the teams of buying and the fund, we've been working and exchanging on some countries, specific countries where those tools and solutions that we are putting in place can work. So there is this aspect. One caveat to it is, everybody wants to know the countries.
Yeah.
Which are the countries? But we want to know the countries, but countries themselves don't want to reveal their names to us. So we're trying to balance those needs. I think the most important is to get the results, to help countries, and once they are over the challenge, then we can talk and celebrate their successes jointly.
Kind of a demonstration effect, yeah. So,
that's right.
You raised, so interestingly, and this is fascinating, on the 3 pillars, and pillar 1, it sounds like, I know that's been ongoing. Pillar 3, very welcome, I think, refining that toolkit and helping countries. Pillar 2, though, that involves the official sector. And Allison, I'm interested in your views. Are you seeing any, are you concerned or seeing any kind of wavering in donor support for some of these mechanisms, like the Common Framework, the Global Sovereign Debt Roundtable? If anything, it might just be a distraction, or there are so many other things going on, I would say. These tools might kind of get lost in the wayside. And so are you having any concerns about that? How is the IMF really trying to keep engagement on these?
So thank you so much for that question, Elizabeth. I mean, first on issues of collaboration with with our official sector partners on things like the Common Framework and the Global Sovereign Debt Roundtable, we don't see any wavering in commitment there, which is great. Now, as Eva said, we see that the risks of a systemic debt crisis are broadly contained. So, you could say, will this mean that people will pull back from things like the GSDR? But I'm very pleased to say that, there's a really clear understanding there's been a lot of progress made. There's still momentum behind it, and I think people still want to take advantage of that momentum and push through and try to address sort of some of the remaining challenges that we face. So really, for some countries that have been going through the Common Framework process, they haven't yet finished their debt restructurings because it turns out that the time required to resolve non-bonded commercial claims, so basically bank loans, has taken much longer than maybe anticipated. And to a certain extent, this is where we're still struggling to find mechanisms to facilitate a more efficient resolution of the non-bonded commercial claims. So I think this is going to be one focus for the GSDR going forward. There's elements of that continue to be around issues around information sharing that would facilitate more parallel restructuring processes. So that work is still firmly on the agenda, and I think people are still committed to that. But more broadly, when I think about the 3-pillar approach, and as you said, the second pillar, one of the big concerns that we have is that in 2024, low-income countries faced a historic high in their refinancing needs, their external refinancing needs. And 2025, we're still going to see refinancing at that levels around like 35 billion a year, and for the foreseeable future. Now, about 50% of that is actually debt that is falling due to official creditors, official bilateral creditors. And so, you know, refinancing that debt, given like all the pressures on official development assistance, is going to be a challenge, and it's one that we worry about. And so at the outset of the discussions on three-pillar approach, there was this question as to whether G20 partners would be willing to do something like commit to maintaining net positive flows, either by doing some rescheduling of existing debt falling due or by providing new financing. And that would be where countries are particularly committed to strong reforms. And so, you know, we understand there are challenges around that. But I think one area that, you know, perhaps is maybe a promising avenue to explore is that we do see a lot of our bilateral partners, you know, very engaged in the issue of debt swaps, right? So some of these debt for development swaps. And so that might be one avenue that could be of interest. I think Eva mentioned like the efforts to explore how credit enhancements could help countries tap into commercial financing, you know, at lower costs. And I think there we do have examples of where bilaterals have provided some support. And so the question is, could they do more of that? And if they do more of that, how would that maybe interact with some of the efforts on the multilateral development bank so that, you know, things work well together, and so that we don't introduce new risks or new impediments to any future restructuring.
Are you finding? Oh, go ahead, Eva.
Sorry, yeah, just because I could not agree more with what Allison has just said, and we see it also in the data. We see how much additional support multilateral and IFIs more broadly have provided to countries, in particular in the recent years. What is a welcome development also is that we see that private sector is like gradually returning, so net positive flows we see that are flowing into developing countries. We also see even last few days a couple of successful tapping of international markets by several emerging economies. So that's positive. But we also see this kind of another element in the flows architecture, the bilateral partners, where the flows are very low, and in some individual countries might be even negative. So, you know, for the liquidity purposes, when under the second pillar, where we try to, you know, get more flows and rally international community around this objective, it would be good to see that bilateral partners are participating in this effort as well. So that's why we, I think, are emphasizing it. And very important is to say that there are different modalities and ways in which this can happen. And very much welcome the point that Allison has just made about the potential, you know, role that that bilateral creditors can play also in providing credit enhancement for some of our guarantees or the guarantees of other MDBs in order to help countries. Because the challenge I think that we have right now is that when countries try to do something about the legacy debt, we find that the legacy debt, you know, that they took before the COVID pandemic is cheaper than the debt that they are currently able to get, right? Like so it's costly. It's putting additional pressure, and you know, so we are trying to look for the sweeteners, and the IBRD comes with, you know, policy-based guarantees or other products, great, but we're doing then the market outreach, and you know, guess what? With the coverage of 60%. We often are getting still the terms that at best match what was provided before, which was uncovered. So we are really facing the very difficult market for some of our clients, and it's hard to compress the cost of financing for them, which is a critical element. So welcome anybody who can actually help us get to that point.
I mean, I think you raise a really good point. You look at the U.S. administration cooperation, right? So we've moved away from grants, and now there's a much bigger emphasis on the Development Finance Corporation and the guarantees and some of the more private sector-based tools that they use. And I wonder if you're getting some receptivity, or maybe it requires more technical work with some of these development finance institutions to say, we at the bank, we could provide this a policy-based guarantee, but we're going to need a second loss if we want to move forward. Can you development finance institution come step in? I mean, is that work that you're kind of pushing? Are you getting any kind of bites and receptivity to that by some of the key donors?
It's work in progress, but yes, absolutely. We all recognize the fact that, the realities of the world have changed, and there is the scarcity of official development assistance, that the funding for even IDA, while the replenishment has been successful, if you look at the contributions that the IDA was able to attract over the past few replenishments, they are, flat almost in nominal terms. So we recognize all that the solutions need to come from also tapping onto the resources of the private sector, and then how to do it and what's the role of the official sector in intermediating some of it or incentivizing is a critical one. So work in progress, but I think we're getting somewhere in those discussions, and many partners are interested in reaching out to us on how they could potentially collaborate with us, including under this unified MEGA guarantee platform solutions that have been put in place last year.
That's great. Maybe just kind of turning a bit to the debt restructuring side of the private creditors, and I know the IMF just released the stock taking around the architecture for debt restructuring and commercial creditors. So any lessons learned that you want to share, Allison, especially as we think about mobilizing more of the private sector in these solutions?
Yeah, so I mean, again, I think that, so the paper looks at sort of the experience with some of the recent restructurings, basically restructurings over the last 5 to 6 years. And what it does find is that it confirms that the contractual approach that was widely endorsed by our boards, by the official sector, of the introduction of collective action clauses in bond contracts and the various enhancements of those collective action clauses, that has actually worked really well to resolve the issue of bonded claims. But again, as I mentioned, as in line with what the GSDR has found, the paper also finds that these approaches don't work so well for treating non-bonded commercial claims. So there is an open question about how can, is there a feasible framework, is there a practical framework that can, really try to help coordinate the issue of resolving bank loans, including because a lot of banks actually move the loans off their balance sheets. So, you have to really look through the bank's balance sheets to actually find out where those claims are actually really sitting. So there's a massive coordination challenge here, and I think this is an area that we will do more work on going forward. But I think some of the other issues that the paper touches on is that it does flag issues around the increasing use of collateralized debt instruments. And, one of the big challenges with collateralized debt instruments, and this could be something that's, a loan that's secured with a receivable of some sort, so a customer receivable, or, we've also seen, for example, the pledging of future commodity production against the claims. The problem with this is that it actually creates a level of seniority in the creditor composition that could complicate a future restructuring. And to a certain extent, this is the balance we also have to think about when considering the broader issue and benefits of credit enhancements as well. As a temporary bridge to uncovered market access, it can play a really important role, but to a certain extent, it could complicate the restructuring process because it creates a level of seniority that may be complicated to unwind. So some of that is yet to be tested, yet to be fully tested. But I think it's a really interesting question. I think we need to think about these things carefully, and we need to monitor what's going here. I guess the other issue that we flag some concerns about in the paper is this issue of judicial awards, right? So again, the potential for litigation to sort of also add sand to the wheels and maybe hold up a complete resolution of a restructuring process. And there again, I think it's too early. We don't have enough evidence to really take a strong view on what could work and what the implications of that is going to be. But it is an area that we are watching very closely.
Yeah, I think you raised some really interesting points around the tension of trying to leverage the private sector more efficiently, effectively, but also on the back end, does that make things overly complex? I mean, on that point, I also want to talk to you, Eva, about the Radical Debt Transparency Report. I love the name. But I thought what was interesting is that that report talks a bit about how there's a greater complexity in debt instruments, which can even contribute to a decline in debt transparency. I mean, what are some of your thoughts around these more complex debt instruments? SCDI, state contingent debt instruments, have come up. I mean, are these things that are useful, but only in the right circumstances? Are they something that we should do more of, but we need to do them more transparently? Just interested in both of your thoughts on that.
No, thank you very much, Elizabeth. That's a great question because we all think of innovation as being usually a good thing, no? But in finance sometimes innovation comes when there is no orthodox or more plain vanilla approach. That's when parties get together and try to figure out the solutions, right? So, for instance, the rise in the complex or we call them even in the report opaque transactions, has also to do with the fact that countries for a couple of years could not raise the financing, entering the international bond market. So what we see, many of them turned toward these like private placements. We see the rise there. We see an increase in collateralized transaction, and Allison has already highlighted here what consequences of collateralized transactions one may face down the road if that needs to be restructured at some point. So this is, I think, this is what we see, and there are significant challenges to transparency of some of those transactions. We also see increase in restructurings. There are a couple of restructurings ongoing as part of the common framework, but there are several silent restructurings, we call them, that are ongoing in between countries. Where conditions, decisions are not very clear to anybody. So I think these times of increased vulnerabilities are putting us more toward trying and looking at those complex solutions that sometimes very much complicate the outlook. And what we need to, I think, do with all of that is to bring more transparency. So in the report, we're advocating actually for better scrutiny on how and when these collateralized transactions are entered. We also want to shed more light on the terms and conditions of individual loans that countries are acquiring, so that there is more transparency, because transparency is a critical step that underpins all investors' decisions. So if you think long term about the growth prospects of those countries, highlighting the importance of transparency, I think, is something critical.
Yeah, especially in this current context. No, I agree. We only have a couple more minutes, but I just wanted to get maybe each of you a couple of final thoughts on thinking about this, all of these trends we're talking about, the decline in ODA, the use of more tools to bring private sector in more aggressively, maybe some shift in strategy around there. Final thoughts on, is this a good idea? Is this going to make it harder to close financing gaps for IMF programs? Is it going to help with bank effectiveness? So we'll leave it.
Yeah, so I mean, I think that, the good news, as we started out with, is that, debt levels are stabilizing, and indeed countries have actually succeeded in meeting their financing needs. Now, as Ava said, a lot of that has been through the use of more innovative or proactive approaches. So we are seeing some very proactive approaches to reach out to new investors, to, we see countries going into the samurai market, the panda market, trying to reach out to new investors, and that's all good. We're also seeing that they're managing their execution risk, so the risk that they have don't reach their financing goals through the use of private placements. Now, to a certain extent, that could be a very sensible part of any debt management strategy, provided actually that issues around transparency are then dealt with. And then we see that, countries are changing the currency exposure of their portfolios. They're taking on new innovative financing transactions, doing more swap type of transactions, derivative type transactions. And all of this could help bring down costs. But our concern is that we really need to see that being done in the context of a really robust medium-term debt management strategy. I think countries need to have the capacity to both understand the risks that are involved and to be able to really understand the broader implications for debt sustainability. And they're not always immediately clear. And I think from our perspective as well, I think we also have to think about how do we have the tools to fully be able to assess those impacts as well. So I think the good news is that they're meeting their financing needs. The question is whether ex post we will have any regrets about how they're meeting those financing needs.
Ava, any final thoughts from you?
Well, I think we need to work jointly, and we're doing it already with the IMF on improving that management capacity so that countries also themselves understand what they are doing, what's happening in their portfolio, and what risks and opportunities are coming from the use of some of those innovative instruments. And the final thought is, we need to be more open to the private sector. That's what we are trying to do. That's what we are encouraging our client countries to do as well, because I think the era of relying only on ODA is clearly coming to an end. So
yeah. Well, great points, and I love the conclusion: strengthening the debt management office, but also trying to leverage private sector more. Excellent points from both of you. Thank you so much for taking the time with me today. Really interesting conversation, and it sounds like our next publication will be on trade, dollar dominance, and debt, and how they intersect to shape global policy choices. That is at 3:30. So looking forward to that. And thank you both again.
Thank you.